welcome to our webinar, Doing Business in an Inflationary Environment with High Interest Rates. Thank you for attending. And I just want to get a few housekeeping items out of the way, and then we'll go ahead and meet the panelists, and we can get into the topic. First, about the format, this is a Q&A, and there should be a function for it to submit questions. We do have a lot of panelists, and it's a big topic to explore. So we might not be able to get to all of the questions today, but we're happy to follow up after, and we'll do our best to try to get to all of them. I also want to thank Edith for putting this webinar together. It couldn't have happened without her. We really appreciate it. Thank you so much for your hard work. And we normally go about an hour, but given the topic size, we're going a little bit longer, so people may drop in and out, and that's okay. If you have to drop, no big deal. There will be a recording of this available, and we'll make that available through LinkedIn, or you can reach out to Carlos or I directly, and we'll send it over for you. Okay, just a very quick plug for the sponsor of the webinar, CJB and Associates. CJB and Associates is a specialized consulting firm focused on food and beverage R&D. Our chef-to-shelf service assists businesses of all sizes in their journey from idea generation to production. We have a very strong emphasis on the manufacturing step. We do that almost better than anybody. So if you're having issues scaling a product or finding a co-man, please give us a call. We're happy to talk to you. We offer free consultations. In addition, for enterprise clients, CJB offers a suite of R&D department services like innovation assessments, innovation portfolio priority balancing, change management, mentorship, and leadership development. And lastly, CJB is leading the way in large language model AI applications for enterprise food, CPG, ingredient, and grocery industries, with a suite of bespoke applications for personalized nutrition, clinical protocol, co-pilots, and stage gate development brief preparation. And in everything that CJB does, the advantage is the same. It's real-world experience customized to your needs. We've walked miles on the co-man floors, iterated thousands of prototypes, and innovated generations of products spanning decades of on-the-job experience. All our associates are some of the most recognized in their field, and we only take on projects where we can bring overwhelming experience to bear. Okay, so that's out of the way. Let's go ahead and go around the horn and just have the panelists introduce themselves, give a brief introduction. Carlos, as you're the head of CJB, you want to go ahead and kick this off?
Sure. Thank you, David, and thanks for the folks attending. We've got a few more dribbling in, but this is recorded, so you won't miss anything if you're coming in late. Thanks, David, again, and Edith for arranging this. And of course, special thanks to the panelists who will be introducing themselves. And I think you'll find all of their opinions interesting, a little bit diverse, and that's fine. And you're welcome to agree or disagree or ask questions. So a little bit about me. I've been running CJB and Associates since 2009. Before that, I ran Global PepsiCo Foods R&D. Took a break from consulting to run Campbell Foods R&D and quality up until 2018, where I retired. After I retired and rebooted my consulting firm. And I won't rehash what David said, but we are happy to help. It's going to be an interesting topic. I'll talk more about why I think it's still relevant, even if you think interest rates are coming down. There's going to be some aftermath, and we'll get into that. But let me not delay further and let David continue going through the round of panelists to make their introductions.
Yeah, great. Jorge, you wanna go next?
Yes. Good morning. Thanks for having me today. I'm Jorge Aspe, industrial engineer by formation. Started my career in logistics, distribution of soft drinks, primarily in Mexico City, which is very complex. A place to distribute soft drinks, but then evolved into finance, having global positions in the consumer packaged goods, Cadbury Schweppes, FEMSA, Dr. Pepper's Snapple Group, in various positions globally, and then migrated into what is financial services in the form of MoneyGram, also a global experience within finance, and later co-founded a technology company that designs and develops software in primarily smartphones and accessories, as well as my own practice in consulting fractional financial services, IC Consulting. Very nice being here.
It's good to have you.
Thank you.
John?
Morning, and thanks for having me as well. I have spent the last 25 years in CPG, food, beverage, nutritional products, and really working at the intersection of consumer insights, business and brand strategy, and new product innovation. A great deal of work with large cap CPG companies and as well with entrepreneurial venture-backed companies. So I have a particular interest in the competitive dynamic therein, namely between the incumbents and those that would disrupt or take share from the incumbents.
Great. Pat?
Morning, everybody. Pat Turpin. My background was I was initially a Wall Street investment banker before joining one of our clients, Costco, where I was an executive for 10 years at Costco, and then left to start my own snack food brand, Pop Chips. And after some other CEO roles in food and beverage space, I became a full-time advisor and board member to CPG companies, mostly food and beverage, mostly in the 10 to 100 million in sales range, where the company's trying to navigate growth, be it in operations, sales, financing, or just building the right internal team.
Great. Thanks, everyone. Okay, let's start really broad, and I'm gonna just ask a question that, and we'll go around the horn, and please feel free to jump in, panelists, and interject your own questions. Like I always say, the less that I talk, the better. We're looking to have a conversation. So given the recent inflationary environment, what are you seeing? How has this impacted your business operations or those of your clients? Could you share some specific challenges that you're seeing right now? And Pat, I'm going to pick on you if you wouldn't mind kicking us off.
Sure. Just given the work I do, I work with a number of CPG companies, some that are manufacturers, some that are using co-packers, but I would say the answers are all the same. One and the most obvious is increases in ingredient costs and labor costs, squeezing margins is something that everybody's experienced that I work with. Now, most of these companies took price increases back in late 01, or late 2021 or 22, but the best companies built in extra because inflation was still ongoing. It wasn't just catching up; it was pricing in to keep up. That created some challenges that in a number of the companies I work with, I see now where they got their price increase, but in a number of these food categories, the sales are flat, but the unit volume's down because in some cases the consumer has been trading away or trading down from those price increases. Another challenge is while commodities have abated in many categories, not all, labor wage inflation is still there with labor shortages. And I'd say the last thing is something impacting cash from inflation is higher interest rates, impacting bank interest that's being paid, and also equity investor market really pulling back. The days of backing money losing ventures for equity investors, there's a lot less cash out there for that, and their criteria has changed. That's what I've seen.
And just adding to that, Pat, I just saw a presentation by CD Insights on the venture funding, and it confirms very much what you just said. Funding in 2023 was the lowest it's been since at least 2017. After a kind of a bump during the pandemic, that was short-lived. They were talking mainly about the tech sector, but we know it's affected the food and beverage and CPG sector in general. They were hesitant to predict when it would free up. They're hopeful that it will be this year, but that's really anybody's guess. So I think in the meantime, it's watch your spending, watch your cash. And as far as the inflation, you're exactly right. Sales flat, unit volume down, maybe profits up, but a lot of pushback now from the retailers saying, hey, I'm getting heat from my consumers, so you need to give me a lower price. On top of that, what is actually working in the industry is food service and restaurants, because after the big hurt during the pandemic, they're doing well. And of course, the center stores are losing that business. So there's pressure by the retailers. And I think you're right, Pat. The answer is you've got to be creative about your cost. At the same time, consumers still want innovation. So it's going to be interesting waters to navigate this coming year.
Great. Yeah, there was a lot of stuff there that I think we're going to dive into. John, what are you seeing? Is there anything you can add to what Pat said, or something you want to dive a little bit deeper on?
Yeah, I think the funding ecosystem as a whole, and certainly it's expressed in venture financing, the downturn in venture financing. But I guess I would argue that what we're experiencing now is more a reversion to some norms that had been violated for, I'll just say, 15 years since the Great Recession. Low inflation, cheap money, and an ecosystem whereby innovation and growth at any cost was rewarded in many cases irrationally rewarded, and that is kind of getting starched out of the industry, and the return to looking at earnings instead of sales growth really being, I would say the last 15 or so years have been a real exception rather than a long-term rule.
Gotcha. Yeah. Jorge, anything you want to add?
Yes, along those lines, I guess the situation we're in my perception, is after a COVID, that affected the whole world, and there was a constraint of sending product from one place to the other, because obviously there was not production in certain areas as it used to be, or any other limitations, and then the geopolitical situations we're also living. I agree with John. There was an increase in inflation. There's an increase in pricing. In our case, freight was heavily impacted, because if a lot of electronics were brought in first by sea, now you had to be thinking on flying them over, because there was really nobody that could take them off from the ports. So that really made the cost of the electronics go up dramatically. But to a certain degree, there were consumers willing to pay for that additional cost, because they really needed technology. Everybody was bringing older technology to their home. So there was a change in patterns. But now, in my view, is more of a normalization back again. And there's a lot of competition out there that's going to have to normalize inflation and get it back to, I don't know if it's going to be the 2% at all, but at the end of the day, inflation shouldn't be that bad. But right now, it seemed to be a little bit out of control. Everybody took advantage of pricing, and now the consumer is probably the one that's going to take the ultimate decision on saying, I continue buying or not. That's pretty much what I'm seeing right now.
Jorge,
if I may, I've got a quick story this addresses the whole volume versus sales versus profit sort of, I guess, dilemma that you might be in. And I remember when I was at PepsiCo, when Steve Reineman was the CEO, and he would always hammer on unit volume. And we would always push back and say, yeah, but if we make profit, what does it matter if profit increases? And he is like, his ears would like close, and he said, no, you didn't hear me. It's about unit. And it really is only kind of like now that I understand where he was coming from. I mean, in a way, we were both right. I mean, of course, profit matters, and that's probably, what Wall Street's going to look at. But for long-term sustainability, you can only go so far if you don't keep the units moving. And I think that's perhaps a lesson if even if you're a small or large business today, you probably want to be paying extra attention to those units because, as Pat said, you maybe have gotten a free ride to some extent last year in 2023 by riding on pricing, and we saw that a lot of the corporate results looked quite good if you looked at profit, but not so great if you looked at unit, and that is not sustainable. At some point, you'll run out of runway.
Well, I think that pain is impending for a lot of the large caps who are in flat to declining categories where really pretty unprecedented price increases were able to mask unit decline. And of course, the bump in at-home eating during COVID was also kind of a one-time benefit that was particularly advantageous to the incumbents as raw materials were scarce, line time was scarce at co-manufacturers, so smaller manufacturers had I would say, relatively more difficult time staying more or less at parity in the marketplace. So I would anticipate that the lack of organic growth is going to start showing up in renewed acquisition activity for one, despite the fact that money is priced more, let's say rationally, and it's no longer essentially free money, but the lack of organic growth is going to begin to show up when the top line is declining and these price increases no longer can mask the lack of organic growth.
Mm. John, if we could stick with you, is there anything in particular that you're advising the clients you work with as to how to make this shift? Like maybe we were dumping a lot of money in before, it was readily available, cost of capital was not that much to do this. Now we need to move back to this more profitable, we need to show profits, this more organic growth model. How are you advising them to kind of make this shift?
Well, in addition to the not terribly helpful advice to manage your margins and be very disciplined about cost, I would say, particularly for smaller players, the number one issue that I've seen over the years is taking distribution that a company is not really prepared to support. And that I think is a particularly dreadful mistake at this point, because there is so little patience and so little dry powder that is available for a business model that is fundamentally unsustainable. So the good old days of it doesn't really matter if we're making money as long as the top line is growing. So I think as a practical matter, in addition to being incredibly disciplined about profitability, the really tempting mistake that I've seen over and over again is, oh, I'm going to take that distribution, I'm going to grow my sales, but it turns out I can't afford to support that distribution over the long term.
Gotcha. Pat, is there anything you're advising to make this transition to this more we'll call it rational, less exuberant model of moving forward?
Sure. First of all, I completely agree with John. What John just said is probably the most common mistake I see early stage brands make, thinking I need to get in 10,000 store doors, even though I don't have the capital to support it properly. And that's not what investors want to see. So I guess what I would say is what I try to, advise these earlier stage companies is that to access capital, first of all, they need to be profitable, or show a clear path to profitability with low losses. The days of we're losing 3 million EBITDA, but we're growing 50% are kind of over for most consumer brands. So having a much narrower loss, but a clear path to profitability where you can show, look, we can literally prove at these volume ratchets, we will lower our cost of manufacturing, whether it's inputs or a co-packer, et cetera, and we can prove this is how much our margins are going to grow. We're going to be profitable. That's what I mean by path to profitability. The other thing is really scrutinizing your banking relationships. In particular, what I've seen is a number of these regional banks that are under pressure after Silicon Valley Bank folded. And a lot of the regional banks were the most generous with their lines of credit. And they're now being forced to tighten more so than the bigger banks. So if you're dealing with a regional bank, start lining up your options, because I've seen a lot of them tighten their terms and surprise companies. The last thing I would say is, getting back to John's point, it's not growth at all costs. It's more about proof of concept, proving that you can achieve above average category velocities in retailers that matter in relevant channels of trade. It's not about how do I get 10,000 or 20,000 store doors. An investor would much rather see you have 3,000 of the right store doors doing great velocities. It's a formula that you can replicate. So kind of the model to attracting capital, as John correctly put it, is really reverting back to what it used to be more than anything.
Pat, is this something that you want to see companies, or you think they want to see companies do on a national level? You could still go after the retailers, but you're being very selective, maybe smaller specialty, or do you want to go on a more regional area? What do you think the strategy is?
So it really depends on the company, their unique situation and product. There's no cookie cutter answer. I've seen answers where the right answer was just prove out regionally that this brand can achieve relevant velocities at some of the right retailers and some of the right channels, and that's proof enough of a concept. And by focusing regionally, you are focusing your marketing dollars more intelligently or support. And I've seen other examples where it's been a broader criteria. So there's no cookie cutter answer, and I'm highly suspicious when somebody says there is a cookie cutter answer to that one.
Pat, is it possible that with let's say unit volumes possibly suffering, particularly in the stores, the retailers, that maybe there might go back to a little bit more emphasis on unit growth, even if the profit's not there?
100%. And to that point, Carlos, I'm also seeing some of the more agile companies adjust their R&D accordingly. So for example, a nut processor I work with, you've got expensive tree nuts that the cost per pound of certain tree nuts is expensive. And in the go-go years, everybody wanted the upscale nuts. Well, in today's environment, that company's, coming out with a line of peanuts because it's much less expensive than tree nuts, and they can make margin, they can show a value. 2-3 years ago, if that company had gone into major retailers with a peanut line, they'd have been laughed at like, no, that's too down market. But the consumer is, to other panelists' point, pushing back on some of these higher price points now.
Can I interject a question for Pat? If a regional strategy isn't the right answer, I'm going to guess that a deep and strategic relationship with a key retailer, Costco, Walmart, Target, Wegmans, would be an alternate strategy. And based on your experience with Costco, which relationship is often considered the holy grail, talk about where you like to see customer concentration, and I'm aware, as many are, of situations where a concentrated Costco relationship has not ended well. How did you think about that on the buy side of products?
That's a great question, John. I'll give you an example of going with a big strategic relationship that is more national, where it made sense. There's a toddler brand called Yumi. It's a food product, and they developed a big e-commerce business. So they were 100% e-com, then going into retail later. And for e-com brands going into retail, where they already have a large established consumer base, they went into Target as their launch account, a deep strategic, large, an example of what you're talking about, John. And that's a great example because there's actually a history of e-commerce brands launching at Target where that becomes a bellwether for success on, hey, if it works at Target, it's probably going to work at other retail. Love that. Costco, on the other hand, can be, I jokingly refer to it as heroin because you get addicted to these large POs and it's cash flow friendly. They pay you in 10 days, but it's here today, gone tomorrow. And if you rely on it, Costco will ride your horse until it's not running at the same rate that they would like to see, and then they will drop you quickly. How I've generally had the most success thinking about Costco is if I overlay them into a broader retail strategy where, say, pick a geography. If I'm trying to expand in the Pacific Northwest or Midwest, and I'm putting out other channels of retail, then Costco can be like paid marketing. If I turn on a Costco region, I get a 6-8 week rotation. I get, 250,000 to 500,000 consumer impressions, and it's paid for. It leaves Costco, and I see my velocities increase at other retail. On the other hand, if I have no retail in, say, the Southeast, and I go to Costco, I see the company high-fiving themselves, and then 6 weeks later, the rotation's over. They have no distribution. The consumer who found their product can't buy it anywhere. So I found that Costco is most cases best utilized as a tool that's augmenting an otherwise developed retail plan, if that makes sense.
It does.
Jorge, do you want to weigh in on this?
Yes, the way we've seen it, and I'm going to probably bring a couple of examples in my experiences. The entry-level customer in the technology arena, typically what you have in those segments are products that are already been in the market, and you're just taking them down on the scale. But it's nothing for them, and what we've seen is that if you cater to the entry level segment and provide them with a product that is developed for them and thinking of them, you typically have a better answer from the consumer, and that is having, in this case, a smartphone with all the accessories you can think of, everything in the box. Something that probably sounds very simple, but most of the companies just go and grab anything that's available in Asia and put it under the brand without really thinking on the consumer. So you really cater to a consumer, even though it's a mid to entry segment consumer, and you're giving them what they require, that typically has a good answer. And also in the money transfer arena, when you talk about no fees or a better exchange rate, you're thinking on that consumer that has a specific need, and wants to send money to their loved ones, probably at a lower price, or they want their money to last more, which is a better exchange rate. So you have to cater to your consumer, is my view. And if you give them a product, you'll probably have a better chance of success and acceptance on your product.
Great. I want to revisit something that Pat said, and maybe try to tie this to the concept of innovation. And this is basically, these companies are offering products, but has the consumer changed as well? And Pat, this is throwing back to what you said about, maybe we had caviar level nuts and now we're down to peanuts. Does the consumer have to make this journey with the businesses as well? And maybe their tastes have changed. I was at the French Laundry, now I'm at TGI Fridays, or I get taco truck or something like that. Are you seeing that sentiment shift? Can the companies push it? Should they try to? I don't know. I'm going to stop there, but hopefully you kind of understand what I'm pointing at here a little bit.
Sure. Be interested in what the other panelists are seeing too, but what I'm seeing is a mixed bag. There are certain retailers, that absolutely are having to adjust some of their product mix and price points to adjust to the fact that the consumer's feeling the heat on inflation. Sam's Club is a great example where recently a particular category buyer was saying, look, items that used to sell at $7.99, no problem, can't move them, need to be at $5.99 or less. But then you can get other upscale retailers, like Costco, for example, that still has a upscale consumer and has no problem, pushing the more upscale price points and products if the quality is truly there. So it's definitely a mixed bag from what I see, but I'm curious what the other panelists are saying.
Pat, we're seeing in our backyard here in Dallas, we see a great contrast between HEB and Central Market. And Central Market, anecdotally, when I go there, I mean, you can barely get through the door. It's so crowded, and I'm not seeing any push for lower prices. They're not even talking about value. And I mean, the cash registers are just ringing nonstop. Okay, it's Dallas, so maybe that's a bit of an anomaly, but you go into HEB and it's much more value oriented. And I can confirm exactly what you said, because from our own product line, we've heard the exact same thing. $7.99 no longer cuts it. They're even saying ideally $5, but maybe we'll do $5.99. So you're spot on. We don't hear that from Central Market at all. So that could just be a smart retailer strategy. It could be because Dallas has some people with more money they know what to do with, and a lot more that don't have the money. But it is interesting to see that contrast, and I think HEB is clearly more the norm when you look at the demographics. Central Market's maybe on the same quadrant as Costco, Harris Teeter, but then the HEB is much more the mainstream. So I can confirm that's what you're seeing. So if you're a brand, it kind of goes back to your strategy. If you say, look, there's no way I can compete at the low end, and then focus on the high-end retailers, and then that gives you time to show velocity, and then maybe introduce a lower price or get your costs down so that you can get into the more mainstream retailers.
I feel like we should talk about Aldi model.
Well.
I mean, is John, maybe you could talk about, I mean, you talked about this reversion to the mean, or reversion to what it really should be. And, has 15 years been so long that there's been so much cash pumped into all these companies that the retailers are like, God, we got to blow our aisle out and have 50 options. And that's as unsustainable as the free cash. And now we're going to see kind of a reversion to fewer select brands that are accomplishing the same goals. What do you think about that?
Yeah, I mean, I agree with Carlos's comment that I'm seeing a bifurcation in the market, which is trading down on the low end, much more conscious about price point and price pack architecture, but also an appetite for better for you health and wellness products. You mentioned Aldi, which of course is the same ownership as Trader Joe's, and I don't live in a big Aldi's market, but I go to an Aldi's whenever I have the chance, and I've been very impressed with well, both from companies who sell to Aldi, who are doing really high quality products, and as well to see their assortment migrate to higher quality, more premium products. So it's interesting that they are such a value-oriented retailer, but I'm pretty darn impressed with their assortment and what appears to me to be a drive for quality and differentiation on that front, much as Trader Joe's has accomplished. But I'd be interested in hearing other perspectives on Aldi. Again, I don't live in a big Aldi's trade area.
I don't either. I have yeah, maybe Trader Joe's is a good stand-in for it too. I have a ton of those around here. But yeah, but other thoughts on this?
I guess I would just add that, Aldi and Lidl are a little bit of a different animal than a Trader Joe's. They get lumped in, but they're really quite different. Aldi, Lidl and Aldi are much more similar to each other in that limited assortment format, and they have a significant cost advantage, and they have been taking more and more share on that. We're talking about, the panelists are all talking about this bifurcated market, that more price conscious end of the market. They're taking more and more share and don't seem to be any signs they are slowing.
How do you see them different than Trader Joe's? Because I have both in my backyard. I think Dallas is the place for retailers.
I think Trader Joe's is a little bit more of a treasure hunt and a little bit more of a, experimental, exotic foods, trend setting. Aldi and Lidl are more catering to a slightly lower demographic and just trying to, get the assortment of that limited assortment right to get as much of that consumer's basket as they can on that limited SKU count. Both retailers do outstanding jobs. They're just a little different.
How does an emerging brand, or can an emerging brand break into an Aldi when they're competing with the huge economies of scale that the big brands have?
Aldi wants to provide what their consumers want as well. So Aldi will have buyers that are looking for newer things to bring in. They'll generally test them. With Aldi, you're generally not going to roll out as an emerging brand to the whole chain, but you can get in some of these regional tests, and if they go well, expand from there. You have to be compelling in a limited selection format. You can't be an esoteric item because they don't carry esoteric items.
Right. So, oh, John, it looked like you were going to weigh in, or nope. Oh, okay. So I was almost going to ask, so if Aldi is growing and they have specialty items that appeal to consumers, that are novel, they're fun, that feel maybe not like French Laundry, but maybe not like TGI Fridays, they're a little more towards that. It is the problem the distribution and the traditional retail? Are they what's really driving up the costs for startups and medium-sized businesses that the consumer is seeing reflected?
I mean, that's a huge part of it. I mean, if you're going into traditional, grocery retail and you're looking at, you're having to use a distributor that's going to, charge you, could be as much as 20 points on their markup. And then you got the retailer who's, looking for, depends on the category, but they might be marking it up 40 points. And then they have all their noise of deductions and charges and programs, which you have to build into your costs. So you look at someone like a Trader Joe's, by contrast, or an Aldi, where you can ship direct. If it's private label to Trader Joe's, they're stripping out a ton of cost. Their markup is lower. And even if you as a manufacturer are selling at the same cost to a grocery retailer channel versus a Trader Joe's, and it's the same product inside the bag, I would routinely see something that might go for $3.29 go for $1.99 at Trader Joe's, and the company manufacturing it's making the same margin. That just tells you how much inefficiency is built into the traditional grocery model.
Yeah.
Right. Right. Because I'm thinking like, what do we tell? They're like, I made the caviar. I'm sorry, we started our company during rich times. We thought this would go on forever. We're really invested in the caviar crackers, you know. We can't shift to the Ritz model overnight, you know. So maybe you have to work with different retailers. It sounds like you have to work with the ones that are going to allow you to do that, right?
Definitely picking an appropriate retailer for your product and your category where your customer is likely to shop is a critical part of any, sales strategy for an emerging brand.
Right.
Well, and especially as the sort of mythology of actually I'm a direct-to-consumer brand, I can target my caviar consumer cost effectively and grow my business without these added costs in the middle that we've just been discussing. Yeah, well, that ship has kind of sailed with customer acquisition costs going through the roof relative to the early days of e-commerce. So that it makes me wonder to what extent the current distribution model, I'll pick on distributors for the moment, may be in jeopardy, seeing this really dramatic difference of price on shelf by going direct versus a number of different hands and margin points getting layered on. So I don't know to what, obviously for small scale brands, that's not going to happen, shipping direct anytime soon, but I would be a little nervous if I were a distributor and seeing those tremendous deltas in on-shelf prices.
Great. Okay, so I have a question from Lisa Thorsten. Lisa, thank you. What is the panel's thoughts on retailers such as Whole Foods, where more novel niche market foods have an audience?
I guess it depends on I guess if Lisa, you could maybe add some context to the question. When you say thoughts on Whole Foods, it could go a bunch of different ways. Is your question more if it's still a good entry point for an emerging brand?
Are they a key player for entry point? She followed up. Yeah, perfect.
Okay.
Oh, okay.
Yeah. I'm just wondering if that's the point where, if you're not going to go into a Costco or a Target on day one, is this a better option than, say, Publix or Food Line or Albertsons or some of the more Kroger, good example.
Yeah. I mean, look, it'd be interesting to hear the other panelists' experience with this, but in my experience, 10, 15 years ago, if you had a natural or organic product, you almost had to start there. And then migrate your way up from there. You're kind of proving yourself. I still think the question of what is your product and who are you appealing to is a critical part of the answer to this question. If I'm not organic or appealing to that some factor like sustainability as a primary anchor of my brand, then it's not necessarily critical you start there. The challenge that a lot of brands are having today is you go into Whole Foods, let's say you get in and you're doing a few $1 million of Whole Foods. That doesn't mean investors are going to be satisfied, because the brands then have to prove that brand can migrate to conventional retail of some sort. Forget whether conventional means grocery, mass, C-store, it depends on the product and the category. But I see in the last couple of years, I've seen this where brands are having to prove they can succeed outside of the natural food store environment. Some brands can, some brands can't. I think that's a critical part of the product and brand strategy from the get-go, is not let's design a product that works in Whole Foods, but how is this product going to appeal to a broad enough audience where I have a sustainable business? So I'll be quiet there and let John and some of the other board panelists jump in.
I would agree with that. I would say in the old days, and we'll say 15 years ago, yes, it was a golden ticket to enter Whole Foods, prove yourself nationally, and really that was in many cases enough to make your business case and perhaps be an acquisition candidate. I think that changed a lot when the ownership of Whole Foods changed. Having said that, they strike me as doing a good job in trying to be more deliberate about supporting innovative brands and being a place where you can discover new products. So I see them kind of recentering a little bit, but even for an organic product or a regenerative product, I would say it's necessary to be successful in Whole Foods, but insufficient. So that is an excellent place to excel, but it's probably not an end game for most companies.
Yeah, and I think I agree with you, John, that they are, I think recentering is a good word. I think the last couple of years were kind of lost years for them. No offense to Amazon, they do great delivery to my door. I think they're learning a lot about what higher end grocery is all about the hard way. I don't know what their sales are, but I gotta believe they took a big hit in the last couple of years. And of course, for them, it's a blip on their P&L, so maybe it's not a big deal. And it's, I guess that's why they bought them, is to learn. But I agree. I've seen what looked like a disaster is starting to come together, getting back to the, hey, let's feature innovative products like Wonder Eggs and some other products that you can find them elsewhere, but they seem to be more prominent at Whole Foods. And I think they're finally starting to get some of their pricing under control, which amazes me, because you would have thought with Amazon's logistics knowledge that would have happened sooner. But I just have to think that, it's Amazon. This has been a learning exercise for them, which is would be expensive for most people. For them, it's chump change. But it'll be interesting to see how they progress, because it's also getting harder. 15 years ago, who competed with Whole Foods? Maybe a local health food store, which wasn't much competition. But these days, a lot of these products that you would have only found at Whole Foods 15 years ago, you can find now at other places, and maybe cheaper.
I feel I must share this story. My wife was sick this week. She's a vegan, and we also had to do a baking project. And so I went to Whole Foods for the vegan pudding, which she wanted, and I couldn't find it there. But I did pick up corn syrup, which seemed odd. I was like, that's weird that I would find that there. Then I stopped by the Safeway, and they had several vegan pudding options, which I was able to pick up. And I was really, and we live in Marin in Northern California, in the Bay Area. Like, it's the sort of hoity-toity is sort of fluffy food consumer you're going to get there. So this I thought it was very funny. This happened this week. Carlos, I think you had a question that you wanted to pose.
Yeah, let me ask a question for the panelists, and I'm going to let Jorge go first, since he's the CFO kind of guy. And I am going to hold you to this answer, so don't, you better be careful what you say. And what I'm looking for is the prediction for 2024. Are interest rates going to fall? Are they not? And regardless, depending on what your answer is, what should we be thinking? So I know everybody likes to make bold predictions and stick to them. So here's your chance, Jorge. I'm not going to let John or Brad off the hook on this one either.
And just as a disclaimer, CJB is not advising you on investments.
Don't hold me liable only to my magic sphere here. Certainly, I see from what I can understand that there's got to be a normalization. Once again, I talk a lot about normalization. So there's an anticipation of interest rates to come down because potential inflation will be also coming down. I guess the next quarter or so will be critical to see if inflation is really under control or not. I still have my doubts of whether the 2% is going to be achievable or not, as everybody's mentioning. 3% or 4%, I think it's going to be more doable. But once again, the 2% has been set out there as a magic number. There's no science to that. It's just been an agreement that 2% has to be a target. But I believe that, yes, interest rates will be begin to come down probably in the second half of the year. And that will then create some options for financing again, which right now have been very restrictive. And on the other hand, it would also help valuations of projects, because if you tell me right now, if I put my money in the bank, it's giving me 5%, I have to get projects that can give me at least 10 or 15% to be able to move, because my cost of capital suddenly has increased more dramatically. So once again, it's that effect of normalization, but also, Carlos, that's what we see in the macro. Before that hits our pockets and the businesses' pockets, is going to take more, because we always see there's a delay. So while there may be some reference exchange rates from the Fed coming down, it'll be probably more time before we can really see the good effect on our pockets. But the mortgage businesses are already beginning to see that, and they're anticipating to that, and maybe within their own way of putting things. Now a 6.6 interest rate seems to be very attractive, but I think it's going to come down. But also we'll have to keep tag of the macro economic situations and what the even the currency can do, the US currency can do against other currencies in some way. That also creates some either inflation or deflationary effect. So let's not forget about the exchange rates, because that's going to also have some effect on how fast we can grow. But I don't know if that answers your question, Carlos, or you wanted me to get a little bit more into detail.
Well, I think it answers. I was looking for a number for December 2024.
I mean, probably interest rates by then could probably be in the 4%, 3.5%.
Okay.
That would be my guesstimate.
All right. Appreciate the prediction. Pat, John,
Pat, any are we gonna have a soft landing here? What are we gonna see in 2024?
Go ahead, John.
Well, so I think I would definitely like to agree that interest rates will come down a bit. I expect the acquisition market to thaw a little bit, and that would be driven both by moderated interest rates, and I think more importantly by the increasing pressure that incumbents are going to feel to show some growth. Again, back to this very aggressive price taking over a couple of year period. That ship has sailed, and there's just such tremendous pressure on the large cap companies to be showing positive growth trends. So I think that the challenge there is that there is a decades-long, let's say, experiment with corporate venture capital and acquiring sexy small businesses, and then really discovering that they don't have a rational place in the ecosystem of a company that is accustomed to managing $500 million, billion-dollar brands, really lacking the fine motor skills to continue to execute against what was a really interesting smaller scale kind of brand. So I think competition for $100 million plus brands that are in double-digit EBITDA territory will be valuations will be terrific. It's just there are not that many of those companies, and without a clear path to sustainable margin structure, financing will continue to be difficult. And I think that you know, over the last 5-7 years, there have been so many young brands that have launched, and with the promise and the hope of a nice exit. And I think that the number of new products and brands is unsustainable, so that there is going to be some cleansing in the market for those companies whose value proposition and operational excellence are not finely tuned.
I guess just real quick, David, my 2 cents on the interest rates. I was just at a Goldman Sachs investor conference recently, and their chief economists were touting sometime this summer we're going to start seeing interest rates, come down measurably. Now, since that conference, some of the inflation numbers, to Jorge's points, have been reporting a little on the higher side. Better, but not as low as people would want. And so the question is, will that slow down the pace of decreases? But I think most people you talk to would say sometime in the second half of the year, we're going to see it. Now, there's interest rates, but then there's availability of credit. Those are two very different things. And for, not the large caps like John's referring to, but smaller growth companies that are dealing more with small banks, regional banks, it's going to take a while, in my opinion, for that to flow through to availability. So if I'm General Motors, can I go out in the fall and probably access a much lower interest rate on debt? Absolutely. If I'm Pat's Snacks, no, there's going to be a lag factor.
And just if I may somehow wrap this conversation, we're always fearful of recession, but any economy has to go through ups and downs. And recession is just a way of saying some type of deceleration. So it's not always bad to have it, but the soft landing we're probably all thinking about of higher for longer may not be that good also, because that means exactly what Pat is mentioning. It's going to take longer to get access to those credits, because we're going to have higher interest rates potentially for longer than anybody was thinking. So at the end of the day, a soft landing, even though it sounds nice because of the word of saying soft versus recession, probably is going to be a little bit more painful, because it's going to just demand more time to be able to get to where we all would like to be again on access to capital and lower interest rates environment.
Great.
So, David, I think we can probably wrap it, rather leave people wanting more. I will remind some of the people who joined us middle of the session that this is recorded. We'll send it out to the same people who accepted the invite, as well as posting it on LinkedIn. Special thanks to our panelists. I am privileged to know Jorge, Patrick, and John personally, and they've also been great source of advice for me personally and for the businesses I work with. So I really appreciate that. Of course, Edith for doing all the background work and getting this all set up, and David for moderating. And just want to thank you again. And I am looking forward to seeing what those interest rates really will be in December and what we're going to do about it. In the meantime, I think we'll summarize the lessons, but it sounds like it's good. One thing we know for sure, it's going to change. And the question is how fast, how slow, and which way. But and I think we didn't talk, Jorge alluded to the international scene too. There's obviously a lot different story going on in Europe and even China. And I'm sure that's going to have impact, whether it's supply chain, inflation, because the dollar gets stronger, who knows? But I think in the meantime, it's be careful with your retailer strategy. We didn't talk a lot about food service, but I think that's, again, one of the bright spots. And maybe if you're a brand, it's double down on food service until the retailer stuff, you can get that under control. But we'll leave it there. Thanks again. Thanks again for those attending and for those who will be watching this on the recording.
Thank you. Bye-bye.
Thanks, everybody.
Thank you.
Cheers.